Charlotte Moore, award-winning journalist and founder of Moore Squared Communications. Welcome to the Professional Investment Podcast. Every episode, we welcome a guest to the show to share their news story of the week. And I'm delighted to welcome Bobby Raddaway, Managing Director of AIMSE Trustees. Welcome, Bobby.
Great to be on the show, thank you.
Do tell us, what's your news story of the week?
Okay, quite a long title. The rise of solar power and China's staggering EV growth may have pushed global emissions into decline. And it was published on Friday, the 20th of September.
And tell us, Bobby, what was it about this news story that caught your attention?
It was 3 days after I went to a conference that week, where I've been going to a lot of conferences for a few years, and I've always thought when they don't mention ESG, but this one did mention ESG. But most of the ESG stuff, China gets a bad press. And then this was the first conference, the first two sessions in the morning were about China and how it's actually contributing well to the transition. And I came away for the coffee break saying, wow, that's the first time I've actually heard positive news about China. And they're actually a lot further ahead than we thought. Then 3 days later, this article pops up confirming that with more statistics and more commentary from two very powerful independent organisations.
Yeah, it's good to have a positive news story about sustainability for once, isn't it? Because it feels like it's just been miserable doom and gloom for so long. And that miserableness has almost got worse over the last 6 months or so.
Yeah, definitely. It's really good to hear that positive story. Now, do you want me to give you a few highlights from the story?
Yes, please do.
Yeah. So a lot of the highlights in it point to the fact that even if China wasn't trying to become renewable, it's a lot of the economics are pushing the move. So we're seeing 30% now of power being generated by electric EV. I'm expecting that to go to 50% of renewables soon, maybe by the end of the decade. We've seen that China actually has half of the electric vehicles in the whole world. And China's actually now coming to the peak of its emissions. Now, it's true, and this is the press we usually get, that China is the biggest emitter of fossil fuels in the world. But China's actually now coming to be the peak of its emissions. And these two institutions have basically said that if China's emissions level off now, then we could, from next year, see a decline in emissions, which we haven't seen since COVID. The COVID decline doesn't really count because the economic activity went right down. But that could then be a decline which is going to keep happening. And they point to things like the cost of solar power is 90% cheaper than it was 10 years ago. So all the economics are pushing us towards, hopefully, being the peak of emissions.
So you mentioned 30% and 50%. Did you mean 30% of all energy is coming from renewables, or 30% of all vehicles are now electric?
30% of all electricity generation
is now renewable.
Yeah.
And it's going to go to 50%.
By the end of the decade, that's the prediction, yes.
And that's globally?
That's globally, yes.
But that's a very heartening statistic.
It is, yeah.
So to bring it back to the world of professional investment, what does all of this mean for UK pension schemes and insurance companies when they're thinking about transition and sustainability?
Well, first of all, for those of us who are positive, trying to make a change here, it gives us a nice little nugget of good news that remotivates us and helps us with the work we're trying to do with pension schemes. But secondly, the big thing it does is quite often the laggards use China as a excuse not to do anything. So they say, even if we do our best, we're not going to make a difference because China is emitting more than anybody else. Now, the second part of that is true. China is emitting any more than anybody else. But it's a bit like when you go to an oil and gas company, they're digging up the most oil, but if they are the places that make a biggest difference. So it actually means if China's now helping to reduce global emissions, every little bit that any one of us does, including pension schemes, is going to help. So it's no longer saying what we do is so small and it's so insignificant because outside pensions, we can't stop what China's doing. China's actually on side with the transition and is helping to solve it. So it gives us the impetus to do our little bit.
Okay, yes. You're no longer fighting against a huge tide. You're going in the right direction.
Yes, exactly.
So I know that we've talked about sustainability and pensions. I mean, I've been running my own sustainability networking events for almost 3 years now. Where are we with that? Where is the progress happening and where is it stopping? What are the challenges for pension schemes when it comes to sustainability and transition?
So the challenges are really where schemes think they can't make a difference. And for both large and small schemes, actually, the first really big challenge is a lot of the time that they put into sustainability is driven by legislation. So if you go to the big schemes, they've got to do TCFD reports and maybe TNFD and maybe social factors in the future. But those reports are really big and really weighty. And we've just seen some schemes fined for not doing them in time. So they take up a lot of their time on ESG and sustainability, even if they're positive ESG and sustainability. So their budget of time to then make a difference is quite restricted. For small schemes, it's even worse. So a very small scheme, a DB scheme, needs to produce implementation statements. They tend to cost between £1,500 and £2,000 a year. For those small schemes, that can be anything between 20% to 15% of their annual budget on all of their investment consulting fee. So that's not just the ESG part, but where have they then got any governance left to do anything on ESG if they're producing this implementation statement, which most of the time is very, very generic? And then you've got, for the big schemes, which is why it's important they get the time to take action, is if you go to the very big schemes like the LGPS, who are quite forward-thinking in sustainability and impact, you find that the pools are having problems with the size of their assets. So they've actually, the funds that are being launched, they can't invest in because they're massively too big. So what needs to happen there, which has started to happen, we've seen a few examples of this recently, is partnerships. And then the final piece of the cake is a lot of the money that's needed for the transition needs to be invested in solutions. At the moment, it's estimated that around 90 to 95% of the money that's going into renewables is going into mature projects, what I've just mentioned in this article, like EVs and solar power, etc. And only a tiny amount is going in to make the climate solutions. And the climate solutions piece, you're tending to invest in early stage companies, risky companies which haven't developed yet. You'll get some of them will fail, some of them will succeed, but that's typically not the area that pension schemes have been comfortable investing in. So
wow, you've packed a lot into that answer, Bobby. Let's unwrap a bit of it. So one thing that people have said to me is it might be challenging right now to do the reporting, but over time it's going to become easier, because it's kind of a familiarity test. Anything new was more consuming. But over time, that will become easier as people become more familiar and maybe costs will go down. Is that a valid point of view, or are you still concerned that that's actually going to just sop up too much pension scheme resource?
So what we cannot do is take TCFD, add on TNFD, and add on another social factor report. There's just not the bandwidth for that. So what I've started to talk to the industry about, an article I had out 2 weeks ago, a pensions playpen I did last week, all about the fact that if we work on the next stage, so the reporting's got pension schemes up to a certain level of familiarity, they know the problem, some of them are quite keen about solving the problem. Transition plans are the next stage. So transition plans of effectively action plans as to how you're going to become more sustainable. And transition plans can wrap up climate, biodiversity, social factors, so you won't have the problem of layering TCFD with TNFD, for example. And I think that if we manage as an industry to come up with good format of transition plans that suit the big schemes and suit the small schemes, one, it'll make it very clear to both the big and the small schemes what levers they have to pull. And two, hopefully the regulator will then say, if a big scheme's doing the transition plan, you don't need to do TCFD in addition. For a small scheme, if you're doing the transition plan, you don't need to do the implementation statement in addition.
So what you seem to be saying is you want to move away from reporting that looks a lot at sort of scenario planning and thinking about how that's going to affect your portfolio, and move instead to what am I actually going to do with my portfolio? Let's analyze what assets I have in it and let me think about the transition. So could you give me some examples, or maybe that, like, so for example, let's say that it was a DC scheme and you had quite a lot of equities in there, and you were thinking, and you've got a passive index, so you might have exposure to the gas and oil sector. So how would you then think about what you would be doing around the transition of that? Would you have a plan around encouraging those companies to transition and thinking about what your points were where you would actually disinvest? Is it about that kind of thing that you need to think about?
So for the big schemes, I think it's more about getting money into impact investments, into these opportunities. For the small schemes, and this might apply to quite a lot of these schemes as well, understanding what power they have on stewardship. So I think a lot of what needs to change is to do with government policy and then action with the managers that hold the shares and vote on the shares. We've already had an example this year, which I ran with Share Action, where a very, very small DB scheme, £7 million DB scheme, changed an investment manager's mindset on the resolution with a big European food manufacturer. Now, that laid the groundwork for a couple of things which schemes can do if they decide that it's their job to change the world and to make the world a better place, and not just worry about their particular scheme and the impact on their scheme. So that particular example, one, it didn't matter whether that client was invested in the particular European company. They were leveraging off their relationship with the fund manager. And two, because they were doing that, it also didn't matter even if they were invested in equities. So all these pension schemes that have got a portfolio of bonds, they can leverage their relationship with the fund manager to get involved in engagement on issues that could matter to the climate and could matter to sustainability. And once we get that knowledge out there and that awareness out there, then hopefully more schemes will come involved in that. Because for my very small scheme, it didn't cost them any money to do that, and they got a very big result. And it was a resolution that any pension scheme could have got behind.
Okay, so because we often hear about the limited resources within pension schemes and how pension schemes need to kind of, like, as you say, leverage their relationship with asset managers, who also, to be fair to them, can't do everything for everyone either, because, you can't have a cast of absolute thousands doing everything. So it's about being more smart rather than doing more. Is that what you're saying? Being smart about how you can affect change?
Yes, and the big thing that needs to happen in the industry is collaboration. So that works when you've got an organisation like Share Action who will say to me, right, I'll say to them, these small schemes don't want to vote on 100 resolutions in a year, but if there's 4 or 5 really big issues that are very clear that pension schemes can get behind, then I'm quite happy to take that to professional trustees in the industry who are quite happy to take it to their small schemes to then go back to their investment manager and back this resolution. So I think for the small schemes, it's about being focused on engagement. For the big schemes, it's about trying to direct money into climate solutions.
For example, does that go back to what the point you were making before, that we have a lot of focus on the industry and existing technologies and existing renewables? So it's about trying to direct money into the new technologies. Is that what you mean?
Yes. And not just new technologies. If you look at biodiversity, for example, a lot of the new funds that are being launched, it's new ways of using agricultural land. It's actually changing use of land, especially in the UK. There's quite a lot of that going on, and it's looking quite good. But the market's not developed, and the funds are not big, and they don't have track records. So it's getting used to the fact that if you really want to make a difference, these assets can make a difference. But they are very risky, though. It's very early stage private equity, and if I give another example, which is just a general fund in the pooled fund space, the historical narrative is that you need to have 5-year track record. And a lot of these funds need money very early on, and if you've got to wait 5 years, then we're nearly in 2030 if funds are getting launched now. So we just need to change a lot of the historical methods and things that people thought the right thing to do to get into these funds, and think if we want to be in this together, we need to look at the ways we can invest rather than the ways we can't invest. And I think a lot of that comes down to a subject you could have a full debate on, which is whether we're universal owners or not, whether it is a pension scheme's job to change the world, or whether it is a pension scheme's job just to look at the risk within their pension scheme.
Yeah, and I was going to play devil's advocate a bit, so I'm glad you've led me into that, because I think you can argue as well that maybe it isn't a pension scheme's job to get involved in the high risk, early stage venture capital, because that just doesn't match their risk return profile. But if you were to make the UK more investable, and this was a discussion I was having with Greg McClellan in the last podcast, then you could attract those investors that are interested in that level of risk into that area. And then once it's developed into something that's maybe in between venture capital and private equity, then you can actually start getting pension schemes invested. It's about encouraging the whole investment ecosystem, isn't it?
Yes. That's why we need collaboration. You'll find that a lot of these funds as well, it won't just be pension scheme investors, charities, high net worth individuals. If you get the ecosystem working and the network set up, it's one of the reasons why I never turn down a contact if they've got ESG or sustainability in their title, because I've just got so much value over the last 4 years of talking to people outside pensions. And the wider you spread the net, the wider the chance are that these solutions will pop up.
So are you saying it's not just on the pension schemes to invest in impact investing and early stage projects? Maybe they have a role a bit later on. Are you agreeing with me on that one, Bobby?
Well, the really, really big schemes can do it early on. The smaller schemes do it a little bit later on, yeah.
So the really big schemes have the bandwidth and the ability to take a bit more risk in their portfolios.
Yeah, especially if we free them up from the reporting. Because at the moment, they haven't just got this TCFD reporting. They've got it hanging over them that they're going to need to add biodiversity, add TNFD, and add transition plans. But I think transition plans can cover the lot.
Okay. And how are you finding the reception for that idea? Are you reaching with resistance, or are people agreeing with you? I mean, it sounds common sense to me, but I'm not an expert.
I've had no resistance to it so far. When I first mentioned that a few months ago, I got some clarity as to who you need to speak to have that conversation. So I thought originally the regulator, and when I spoke to the regulator about it, they were quite happy with it as a potential route, and they said, but it's not our issue. You need to speak to the DWP. So again, it's shortening all the paths all around the industry and all around government.
Yeah, well, let's just hope you're not handed off between government departments, Bobby.
Yeah. It's not just me. I'm setting up a group where there'll be quite a few of us doing this.
So for this, to recap, for the large schemes, they need to be involved in a bit of the riskier projects earlier on. They've got the capacity to do that. The small schemes need to think about how they can think smarter about their resources, how they can leverage their relationships with pressure groups, campaign groups like Share Action, and with fund managers and with other schemes. Are there other things either of those groups should be doing around this?
Well, the smaller schemes probably need to make sure their consultants are bringing these issues to them as well. So I'm obviously talking to all the consulting firms about this, and I've spoke to the ICSWG about this. And so all schemes do have a route there. But when the thing is with ESG that the enthusiasts are few and far between in all the organisations. So the professional trustees like myself need to be the evangelists within our organisations, and the ESG specialists within the investment consultants need to be evangelists within their organisations. But we need to let small schemes know that they've got power here, and for example, if they change in fund, just to make sure that their consultant puts in front of them a sustainable version of the fund, and it may or may not be appropriate. We did that with my scheme early this year, and the sustainable version wasn't appropriate. But at least ask the question and make sure it's been brought to the table.
Okay, and are you focusing only on the DB space, or are there takeaways for DC schemes as well and for master trusts?
No, I think I'm focusing on all the areas. Master trusts I'd put in the same category as the large DB schemes, the same category as the LGPS. They are all making very big strides in this area. They're the leaders. They're the people that, if you freed up their time on reporting with a very, very clear transition plans, would actually be very quickly putting more time into action rather than in reporting.
Okay, and give us a flavour of what you mean by that. Whether you say that the large schemes should be impact investing, what kind of things should they be investing in?
So they should be looking at early stage. They should be looking at where they can co-partner with other funds. And I think the most obvious one at the moment is the biodiversity area. Climate's a bit harder, climate's a bit further developed. But they should be having conversations with the fund managers, because quite often the fund managers are waiting for the feedback from the industry as to what funds they should launch. But a lot of what needs to be done in this area is partnerships. And partnerships could be across different groups as well. So I think there's a lot of asset owner groups out there and consultant groups out there who should just be speaking to each other to try to find these solutions that we can start opening up for investment. Because I'm not being very direct in terms of what particular funds they should invest in, because part of the reason is that a lot of the talk over the last few years has been how to do climate modelling correctly, or how to bring biodiversity into the reporting, or how to bring social factors onto the table. And these are, let's nail this reporting thing. Let's get it sorted out so that we can actually look in more detail at what are the actual assets we can get this money into.
So you're saying that not enough thought has gone into, should we, for example, be thinking about holistic solutions that reinvigorate the environment of an area that might appeal to an LGPS, for example, or whether we're talking about, for example, I saw Nest announce last week that they're producing, they're going to be investing a lot in rental accommodation and how we can factor in sustainability around that. Or so there's almost, everybody's so obsessed by the reporting, they haven't had the time to think about, to go back to your transition point, what assets should I actually be invested in, and how do I implement this, and how do I make my portfolio net zero by 2050, for example?
Yeah, so you pulled out some really good examples there of which funds to invest. These new funds are happening, but that needs to be leveraged across the industry. That's the bit that's not really happening yet, but I'm positive on it. I think it will happen. But they're just a classic example. Some of the biodiversity funds were just too small for the big LGPS investors. So the thinking is going on, and some really, really good people there, and some really, really good investments there. but it's leveraging off that and getting the conversation moving towards that now and away from the reporting across the piece. I think if we do offer schemes a way out on reporting, so that they can, it's not a way out actually, it's resetting the setting of strategy. If you look at when climate risk first came onto the agenda, what you should have done is assessed climate risk, assessed your opportunities, assessed your risks, and then put in place a plan and then disclosed what you did. What's happened with pension schemes, they've been dragged in at the bottom with disclosure and never really gone back holistically, started from the top. And we need something like transition plans so they start back from the top.
Okay, so final question for you, Bobby. If we were to, let's be optimistic and assume my podcast is going to last for another 5 years. If we were to have this conversation in 5 years' time, where would you hope that we would be with sustainability and pension schemes?
So I hope that every scheme will have a transition plan which gives them a very clear indication of which levers they have to pull, and that every scheme will then know how they would pull those levers and at what point they would pull those levers, and that we would see very active stewardship from the smaller schemes upwards, and we would see a significant amount of pension schemes assets in either sustainable funds or sustainable solutions.
That's a great place for us to end our discussion. So thank you so much, Bobby, for coming onto the show, for sharing your news story of the week and all of your insights and comments. Listeners, very welcome to the show. Listeners, I hope you enjoyed the podcast. And if you want to make sure you never miss a future episode, click the subscribe button. If there's somebody you would like to hear and see on the show, please get in touch. Thanks for listening.